All right, Lata. We'll continue to get your opinion, but here is some live opinion now. Ed Yardeni is president at Yardeni Research. He's joining us now to take some questions. Ed, great to have you back on the program at CNBC-TV18. Thank you very much for your time. We were looking at the sharp outperformance in markets like Hang Seng, etc., and kind of correlating it, contrasting it against the tepid last 2 months that the main Nifty index here in India has had. Right. Is that, 2022 all told has been good for India relative to the rest of the world. So is this just some rebalancing, money chasing the big underperformers, which is going on?
Yeah, I think that's absolutely correct. I think global money is looking for better valuation multiples in an environment where the major central banks are raising their interest rates. So it's absolutely a rebalancing, but rebalancing it tends to be more of a long-term approach to running money. I think a lot of this is trading money. I think people are betting that now that China has abandoned zero COVID, that they will get a very intense wave of infections, but herd immunity may occur sooner rather than later. And so people are looking for peaks in this wave, and some are seeing some here and there. But all in all, I think it's a lot of it has to do with chasing China, which got awfully cheap with the zero COVID. But in addition to that, India has had a great run in 2022, and I think it's due for a bit of a rest. I don't think it's going to be much of a correction because, as you mentioned, there is increasing interest in emerging markets in 2023. And India certainly is at the top of the range of a lot of emerging markets in terms of the underlying fundamentals.
Okay. Good evening, Ed, and thank you very much for staying up for us, and have a very happy New Year to you. Have a fabulous 2023. How do you understand what the FOMC was telling us and the jobs data that we have got on Thursday? The Fed seems to be saying that you guys are pricing in rate cuts and that's making our job tough. Now, that seems to be the message, but how will the markets move forward on this?
Yeah, I think that's one of the reasons the stock market in the U.S. did badly today is everybody read that one little sentence in which they said, the Fed officials basically told markets, you're making our jobs harder because you're not going down enough. You're not creating enough financial tightness. And so I think the Fed really just wants to communicate that they are going to raise interest rates some more. I think they're going to go to 5.25%. And I think then what they're trying to convince the markets is that they're going to stay there for a while. Historically, that's very unusual. Historically, the Fed raises interest rates and then overdoes it, and then rates start coming down. So I think the Fed doesn't want to overdo it. I think they want to get it just right, and they're sort of upset that the markets are making their jobs a little bit harder.
All right. Good morning, Mr. Yardeni from here in India. Mr. Yardeni, there's been a lot of focus on emerging markets, India and China. I was looking at yesterday's performance itself, and the FTSE, that's suddenly doing a relative outperformance. And the FTSE is actually closer to its all-time peak, which is a bit of a surprise, right? What's your sense about, some of these developed markets? Some of them got bombed out last year, and they've quietly clawed back. Your view?
Well, I think all in all, over the past couple of years, it's been pretty clear that the United States has sort of been the hot market among developed economies, and got too hot, led by basically 8 stocks, the so-called mega cap 8. Their valuation multiple got to over 30. Now it's closer to 20. And so a lot of what's been going on in terms of relative performance has actually been led by 8 stocks in the U.S., and now they're clearly underperforming. And as a result of that, there isn't the perception that the U.S. is going to necessarily be number one. And now all of a sudden people are looking for better valuations, and they're finding them in China, they're finding them in Europe. And Europe, of course, still has some challenges, but sort of the worst case scenario of a bad recession in Europe, because it would be a very cold winter and they just wouldn't have enough fuel to heat their homes and their industries. That hasn't panned out. Quite the opposite. The weather's been remarkably warm, and storage of natural gas is running around 95%, and they've been able to kind of protect themselves very, very well. So I think the investors are going more global now, maybe giving less emphasis to the U.S. in areas that have outperformed, like India. But I don't. I think the underlying fundamentals for both India and the United States are actually still pretty healthy. I tend to be one of the few optimists on the outlook for the U.S. economy.
Okay. Now, how would you, see the current year coming up? Will it be much like last year with big falls in the U.S. and less so in countries like India and Asia? What would your pecking order be?
Well, you're saying what would the pecking order be? I
separate
would say
questions.
that,
Two separate questions. What would you say would be the kind of fall or performance of the U.S. markets, and what would your pecking order be?
Well, the consensus view on the U.S. stock market is that it's probably going to be flat this year, but the consensus view is that it's going to be down in the first half of the year and will make a low by the middle of the year and then rebound. I'm thinking that the U.S. stock market's going to continue to be in this range, just below 4,000 and maybe above 3,800 for the next few months, and then I think it moves higher. I think this year is going to be an up year for the U.S. stock market, but it's hard to get wildly excited about the market because valuations are still relatively high at around 15, 16, and earnings are going to be challenged. They're not going to go up, but I don't think they're going to go down. I think they're going to go sideways, but it's not a very exciting environment. I think, again, the focus is on valuation multiples, and we know that Asian markets have been relatively cheap compared to the U.S. European markets have been relatively cheap. So maybe for the first 6 months of this year, the opportunities will be outside the United States rather than the focus on the U.S. I think there's still some ways to go for the mega cap 8 to give back some of their overvaluation, some of the air out of their bubble.
All right, Ed, thanks very much. Great speaking with you. It's
Thank
always
you.
a pleasure having you with us here on the program. So it gets a little worse before it gets better. The question is how worse and how quickly does that start to turn? At what point in the year, if it does turn this year? We'll take a quick break here. Our list of top stocks to watch lined up next with our research team. Stay with us. We'll be back with that.